Folks, I am safe. I am safe. I am safe. I said 3 days ago I would have to eat a bucket of mayonnaise if the Fed raised rates. Well, guess what? We didn't get a cut. We also didn't get a raise. We paused for the what marks now 12 months. It's been a full year of the Fed pausing. Thank you, everybody, for being here. This is the start of a long stream because we're going to be doing meta earnings as well coming up. So we're just going to go until market close. Jerome Powell and the Federal Reserve have once again paused interest rates. Rates have now stayed at the same level since July 2023. It has been a full year at these levels. Now, how is the market reacting to it? How is the market reacting to it? Really, the market kind of doesn't care that much. By the way, I was looking at Lockheed Martin today. They got upgraded to $635 today. They were at $428 3 months ago. So Lockheed Martin has just had an incredible year. But AMD gave up a lot of its gains. It was up 10% at one point. Now it's up 3%. NVIDIA up 12%. So NVIDIA kind of took the gains from AMD and just brought it over to their side. Match Group up 13.7%. S&P up 1.7%. Now the S&P was up almost 2% on the day. So S&P hasn't given up too much of its gains. But still, it was at 551.71. Now it's at 551.14. Tesla's still 231, up 3.87%. It was up 4% at one point. Robinhood was at 21. Now it's at 2064. PayPal's at 66.18. Got upgraded today. SoFi, really a surpriser of the day. SoFi got to 783 like 30 minutes ago. Now it's at 757. So the broader market, Microsoft recovering most of what it lost yesterday. The broader market really does not care. NASDAQ right here up 2.8% on the day. I think what we're waiting for now, Bitcoin 66.1, is what Jay Powell's going to say. Because if Jay Powell says something good, and he'll be talking in about 4 minutes, then we're going to see hopefully some momentum. Now, the Fed notes did come out as well, and the Fed really didn't say... they didn't say anything that different. So here's the notes. This was the Fed release. A couple of things were changed from last month's release. So they said job gains have moderated. Last month they said remain strong. So that's a downgrade from last month. And the unemployment rate has moved up but remains low. Inflation has eased over the past year but remains somewhat elevated. That's a new word they added. In recent months, there has been some further progress towards the committee's 2% inflation objective, basically saying, hey, we still need more data. Now, granted, this is what they're going to say. I expect Jay Powell to be slightly neutral to dovish. He's not going to be like, yeah, we're definitely going to cut in September. He might say some things here and there that's like an obvious signal that they're going to cut in September, but he's not going to be super explicit, but that's okay. At the end of the day, we know that inflation is coming down, and I think the Fed knows that as well, especially given the labor market data we got this morning with job growth at the lowest in the past 6 months. They also said the committee judges that the risks to achieving its employment and inflation goals continue to move into better balance. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. Very bland stuff, but still making the case that, hey, we do believe inflation is coming down. We just need more data to kind of justify that inflation is coming down as well. And so we're going to see what happens. Now, again, NASDAQ is up, S&P is up. So really Jay Powell just has to not mess anything up. Quite frankly, I think he could say something that could push up the S&P back closer to 553. We're at 550.99 right now. We're going to be 551. I think 553, 554 is possible if Jay Powell really speaks in a way that is very obvious that the Fed is teeing up the September cut. I don't think he's going to be that explicit, but if we read between the lines, maybe we start to see him say certain things. For example, if he says, yeah, shelter inflation is definitely coming down according to our checks, or the lag that we've been seeing in the past 6 months has stopped. Or, he talks about the fact that the labor market is weakening more aggressively than he thought, or that the Fed thought. You have the inclination to believe, okay, well, if you think that's the case and we look at your dual mandate, you are going to then cut to relieve some of the problems in the labor market. A lot of esteemed economists believe they should be cutting in July and that they're making a mistake waiting too long. It's just a July cut from a political perspective was never going to happen. And we did get more jobs than we thought we were going to get with the JOLTS data yesterday. So you can make an argument that maybe inflation is somewhat sticky, but I think at the end of the day, the Fed knows it's not sticky enough to continue to keep rates where we are. And so let's see. Bsoft says Meet Kevin has changed his mind, or it looks like he changed his mind about this horrible recession after this report. Yeah, I mean, look, I think the recession thing is hard to believe, just given that unemployment is not as bad as it seems. That's my basic barometer to figuring out if we have a cataclysmic recession on the way. Jay Powell speaks in about a minute. So it makes sense that Meet Kevin is turning a little bit more bullish because the Fed is saying the same thing that everyone's saying, which is that, yeah, the labor market's weakening, but we're going to look at the data. And if we see the right data, we will cut rates, implying we're going to cut rates. It's just going to take another month to get there. Shout out to Derek. Okay, so this morning, Derek, shout out to Derek in the chat. He bet me $100,000 that the Fed would cut rates. And for a second, I was like, I should take this bet because I pay more attention to the macro because I'm in the shit all day. I can win this bet. I knew the Fed wasn't going to cut rates. And I was like, no, let's not do 100,000 because on the slight chance you're right, I don't have $100,000 to give you. I know you have $100,000. I don't have 100,000. So then he was like, all right, let's bet $1. And I was like, fine, let's bet $1. So I got the Apple payment for $1. And then I was like, fuck, I should have betted $100,000, dude. Like, could you imagine he had to give me $100,000 on this bet? That would have been fun, dude. I know. I said no. And Derek is a man of his word. He would have followed through. But I was like, if I lose, then I have to give him $100,000. I don't have $100,000.
Economy has made.
Oh, we started. All right, we're live with Jay Powell.
Considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, here we go. Here we go. Here's questions. Let's see what he has to say. This is when the market reacts. Here we go.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Okay, he at least says
So
it's
you asked,
possible.
why not today? And I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
That's dovish. That's dovish. That's pretty damn dovish.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
I think that's dovish, folks. I think it's dovish.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates, and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those 2 things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation. And we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Russell's at 226, folks.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of, I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. It's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
S&P is up 2%. Wow.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market, and, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this. We raised rates a year ago at the July meeting, and if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, I think, unemployment was in the mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is, how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most you would think in a base case that policy rates would move down from here, but I don't want to try to give specific forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
He just said base case rates move down from here. Wow. There you go.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data, and things like the ECI report, and frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy, and it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months were reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably down to 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Bro, we are mooning, folks.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, now labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year, and the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk basically with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data all of the data, and not just it, and then how is that affecting the outlook, and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in, and so much happening between now and the September meeting, and we'll make a judgment.
Bro, this is wild.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Wow. So they explored a July cut. He said they had a real debate about it. I think we're getting the September cut.
Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction. Whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate sensitive, interest sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. You're just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria. Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the Fomc rule? And would that potentially affect how quickly you cut rates?
I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more, it starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think, history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples. So it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters.
Yes.
So
right.
Many pieces of received wisdom just haven't worked. And it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of admittedly very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Such a good answer. Such a good answer.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the nonprofit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness, and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter, so it's just hard to measure economic activity. There are it's just difficult to do. So I look at both. But I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you.
Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do. And I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation again is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary, but we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically, we have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
Hello, Jean Young with M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Dude, what are these questions?
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go around. And then this morning we have the monetary policy go around. And I think in people's economic go around and in their monetary policy go around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so, in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting. But overwhelmingly, the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming
Yes.
inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question. That is the case. That as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Again, that's bullish, but he just said that like 20 minutes ago.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off anymore for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make. And what you see is the judgment of the committee is that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market. So that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see, which way the economy heads, and I think if we are to respond to weakness, we're certainly, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and a good labor market and inflation coming down.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
Yeah, I mean, I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And, you know, when you're saying you're going to be data driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things, the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan to. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
All right, folks, there you go. Mr. J. Powell just pumped up this market. And quite frankly, I think most of us knew that he was going to be dovish, because all of the data we've been looking at every day, basically for the past 2 months, because the first 4 months of the year, inflation was still sticky, but the past 2 months, basically 3 months, we got really good data, including the last CPI report. And so Jay Powell kind of had no choice but to signal that he's probably going to cut. And although he tried to avoid explicitly saying it, there were certain moments where he said, it is definitely, he verbatim said those words, it's definitely on the table, and we will be taking a look at that conditionally based on the data. He adds the last part just to make sure he doesn't sound super bullish. But the point is, it seems more likely than not. He also said in the July FOMC meeting, they had a debate. All of them agreed we shouldn't cut yet, but they had a rigorous debate. And that debate is good, because 3 months ago, there was no debate. 3 months ago, it was like, there's no way in hell that we're cutting. So things have fundamentally changed. IWM at one point hit 228.63. Now it's at 0.62, selling off just a little bit, but it's up basically 2%. Broadcom is up 10%. TNA leveraged against IWM is up 6%. S&P at one point was at 553.5. That was up closer to 2.5%. Now it's up 1.7%. This tends to be the natural sell-off that happens every time after Jay Powell speaks. So not that big of a deal. But the fact is, Jay Powell didn't say anything that would necessarily tank the markets, even if we're seeing some red candles right here. Robin at $20.92. SoFi at one point hit 780. Now it's 769. Regional banks are up about 1%. Tesla up 4%. Uber up 3%. Meta, we've got earnings for Meta in about 40 minutes. They're up 2%. Qualcomm's up 5%. And look at NVIDIA up 12.45% on the day. Nothing I heard. Let me know what you guys thought in the chat. Nothing I heard in that conference at all signals fear of Jerome Powell around a catastrophic recession. There is some worry that the labor market is weakening. There is definitely a couple key points he made around consumer spending becoming weaker. And so all of the signals, again, point to this cut that's probably happening in September. And all the questions he was answering were also compounded off that initial opening statement, which is that, yeah, we think inflation is moderating. And if we see the right data, then we're going to act in the way that's important. Now, one thing that he did say that I want to highlight, and I'm curious if you guys noticed it in the moment when he was speaking about it, because I think this is a point that we've been making a lot on the market open, which is someone asked him about the SAM rule, about unemployment and a recession and what happens when certain indicators move in certain ways. You see certain dots go here and there, and then boom, recession, which has basically been Meet Kevin's kind of thesis over the past 4 days as he's been, claiming there's going to be a recession. He's looking at all these different data points. Jay Powell said the one thing that I feel very few people have acknowledged, but it is the one thing that sets up the foundation for the entire bull run that we've had since the beginning of 2023, which is that this is absolutely an unprecedented economy. He went into the point of saying, hey, we printed a lot of money. We had COVID. We had a pandemic. We had 15% unemployment. Then we had a presidential administration change. Then we printed more money. Then we had inflation rise, the highest in 40 years. Then we raised rates, the highest that we've ever done in 40 years. So he said, look, there's so many different indicators, so many different arguments, so many different random things that have happened that to say, oh, XYZ happened, therefore SAM rule triggered, therefore recession. He basically said that's fucking stupid. I mean, he said it in a more intellectual way, but he was like, that's the absolute, how can you just assume there's going to be a recession using this historical precedent when nothing has gone historically accurate over the past 2 years? The biggest, FU to the market has been the yield curve inversion, not triggering some massive recession. So Jay Powell's argument is like, you can't be asking me to say that we're going to have a recession if nothing has necessarily happened in the past 2 years that has been historically in the same way. I'm getting a call from Chris. Let's pick up and let's get his take on the macro. Chris, you're live. What's up?
Nothing much, man. I was going to ask you about the status of those Robinhood spreads, man. And I was going to try to advise you to, when this thing runs up after earnings, to possibly roll them forward so that you don't get stuck with them last minute.
Okay, so this is a good conversation. So I want to ask you about that, but I want to get your take on Jay Powell as well, because I think what you said is going to be important for other people that are risk managing. So first of all, Jay Powell, what was your raw thoughts against what he said?
To be honest, I don't know what he said because I was out looking for a house with my wife, actually.
Okay, so Carnival is printing so much that you don't care. Okay, all right. That's basically what we got.
You know what? Here's the thing. So I don't know what he said. So let me try to make a
He
prediction.
basically was super. Okay, yes, you go. Before I tell you, go ahead.
I'll make a prediction, and then after that, you can. So first of all, I mean, you gave it away a little bit, but I'll try to piece it together anyway. I think he was dovish enough to the point where people are probably thinking that, yes, September rate cuts are guaranteed, and which is why the markets are ripping.
Yes.
The only thing is, the reason why they're cutting is because they're seeing a lot of slowdown, which is not good for business. So it's kind of like a catch-22, which is the economy is going down, let's start cutting, but that doesn't mean that the economy is not going to, not keep going down. So,
Okay, so that is correct. The one pushback I would say against that is that the labor market is weakening, but not weakening to the point where it's like COVID level recession or anything, right? So do you think the rate cut is a hedge against that, which means it's bullish, or do you think we're cutting into real weakness?
So, it's going to depend on which sectors, because remember, for a true recession to take a hold, you need a triggering event, right? You need some sort of crisis that comes along that drives the markets going from very confident to no confidence at all. We had that tech bubble burst. We had 2008. We had the great financial crisis. You know, during COVID, we had COVID, that whole situation. So the question now is, what is going to be the trigger for this recession? And if there are no real triggers that are out there, then the chances of a recession are not really that high, right? So the question that we all should be asking ourselves, what trigger is most likely going to be the thing that causes a recession? I personally think it's going to be a retracement in the semiconductor space, because I think if you look at the earnings on semiconductors, they've gotten way out of proportion. And now, you know, if there's any sort of like indication that future demand is not going to be there, you're going to see a huge drop off. And I figured that the market would recognize that with everything that happened with Microsoft, where Microsoft missed on cloud by just an iota. They didn't even technically miss, in my opinion. But look at what the market did. It sold off Microsoft almost 7 to 10%.
Yeah, but Chris,
Nvidia
to push back, Microsoft gained everything because it was a stupid sell-off, right?
I understand that. But the point is, this is the level of jitteriness that's in the markets. So the people that are looking to get out, they're looking for reasons to get out. You know, so if you can make a compelling enough argument why you should get out, bro, the entire market is going to dump. And especially a lot of the big names, like within the AI space, they're the ones that are going to take the brunt of the downward move.
Okay, so what are you exactly predicting by the end of the year? You think, because this goes back to risk mitigation, right? Selling options, things of that nature. If you believe we're headed into a downturn, yes, risk mitigate. Like aggressively, right? Sell a lot. But if not, if you think this recession's a year from now, given semi-demand, whatever you think, what is your advice over the next 4 months?
I would say 2024 is going to be a bright spot for us. I don't think that there's any sort of material weakness coming our way. I do have to just say that for 2025, we should all be applying some caution and not be in the most speculative parts of the market. Right?
I agree with that. Yeah.
Be in companies and be in sectors that the valuations are a little bit easier to digest, and not just be in 100% growth, you know, no matter what. Because usually what tends to happen is, you know, the markets will go up really high, and then eventually when the correction comes, it'll knock everything down. But the growth companies usually take the biggest downward movement, and the value companies typically, you know, they'll stay somewhat stable. So I'd say this is the time to high class your portfolio, high quality that shit up. Don't be in speculative companies. And yeah, I think there's tons of opportunities within, I think, small and mid caps right now, and even the large caps. So one of the strategies that I've been applying, and it's been working okay for now, is instead of being in SPY, instead to be in RSP, which is being in, remember we spoke about it last week.
Yeah,
So
it's
instead
equal weighted S&P. Yeah.
Right. So this way, what happens is there's a tons of companies that are large cap companies that are doing extremely well. They're going to benefit disproportionately from the rate cuts, and they are going to end up, you know, like gaining, you know, proportionally, they're going to be gaining more than the Microsoft, the Nvidias, and the Googles of the world, which are already trading at such a high premium. You know, so long term, everyone should be in SPY. Short term, this is once in a, I guess, like 10 year, 20, you know, I think it's probably closer to 10 years time frame where mega caps have really outrun the rest of the market, and the alpha is in the broadening trade. You know, another place to also look on it, I don't know if you delve in this, but yen, man, the Bank of Japan is raising rates, we're cutting rates. That's huge for Japanese yen. So I think Japanese yen is going to rally back to at least the 110s. Right now, I think it's at 150, but you can see it moving.
What is the ticker on that? I know you tweeted it, but what's the ticker?
YCL. It's
YCL.
a leveraged bullish yen play, and it's up, I think, almost 3% today.
Okay. So overall, you feel, just to everyone to get your overall perspective for the next 5 months, you're not bearish, you're bullish. Correct?
Yes.
Okay.
Yes.
right. Just making sure. But then 2025 is whatever. We'll see what happens in 2025.
I would say you have to be careful because remember, black swan events can happen at any time.
Yeah, Trump almost got shot. You're right. Yeah.
Yeah. The problem that tends to happen is, especially with options, is that imagine you're up 400% or 500% on your options position, and you're literally at 30 days from expiration. You think, oh, yeah, this is going to expire in the money. I'm going to make all this money. This is great. And boom, last second, this thing retraces 10, 20%. And now all of a sudden, all the gains that you've had for the last year and a half, all that patience, all that waiting, you completely, destroyed. So this is where you want to incrementally, either sell out of the position so that this way you're not caught off sides with a short-term timing event. And also at the same time, consider rolling things out further.
Right.
So my thing is, that's what I typically do with some of the options plays that I have, where it's like TFC right now. TFC is at the top of the $45 target. Now, of course, my target is $45 into 2026, but I think that TFC has some room to run to 55 by 2027. So when the options for 2027 come out, I'm probably going to roll some of that position, not a lot, roll it to the $55 range. So now what happens is I'm taking the gains that I already had from the run up from the 27 to the 45, and now I can incrementally gain more on the other side.
And you buy more time, which is always good.
Exactly.
Yeah.
Time is your best friend, but also your worst enemy. It just depends on the perspective that you have. So if you have a lot of time, it's your best friend. If you don't have a lot of time, it's your biggest enemy because it'll keep you up at night. And if you don't sell look at what happened with SoFi for you. You were up so much on SoFi, and then you were kind of forced to move. So I think sometimes what happens is people, when it comes to the stock market, you can be in things long term. You don't have to worry about it. Keep chilling. And if things go down, whatever, you've got plenty of time for things to recover because you have unlimited time. With options, you don't have unlimited time. So you have to be very judicious with the way that you allocate capital. And also to make sure that when you are up and you're up disproportionately, you at least take your principal out and say, you know what, the rest I can let it ride, and then slowly take money out of the market so that this way, you're not going to be exposed to last minute changes in the economy. And once again, you and I both know the company fundamentally could be doing extremely well, but the economy, if that sours or something happens like a black swan event, bro.
Speaking of a black swan event, Iran's leader has just ordered a retaliatory attack on Israel per the New York Times that broke just now. So
long Lockheed Martin.
I mean, dude, they got upgraded today to 635. There's events. Okay, Kris, but before you go, I got to ask one question. Palantir got upgraded 2 times by Citi and Jefferies over the past couple of days, and the upgrades are pretty hilarious. Both analysts are like, yeah, it's overvalued, but we're still increasing the price. What do you think about Palantir going into earnings? Oh, see, I talk about Palantir and he leaves. He disappears. This is what. If you want to scare Kris the bear away, you just mention Palantir and he gets out of here. He'll probably call me back. But guys, I'm going to move to a new stream at 3:45 for Meta earnings. I know it's annoying. It's already set up though, so you can pull it up on the other tab. The reason is because no one's going to find Meta earnings on the JPOW title that this stream is for. So in about 5 minutes, I'm going to get off this, literally start the next stream. It's already live on my YouTube. And we're going to switch over to that one because we need to title it correctly in order for people to get there. Let's call him back. This motherfucker always leaves when we talk about Palantir, huh? He was like, I don't want to answer Palantir. Kris, you just magically left when I brought up Palantir.
No. Sorry about that. No, my wife, she went in to get us some sushi for lunch. And basically, the Bluetooth disconnected.
Okay, gotcha.
Disconnected mine and does connect to hers. But so this is the problem with trying to short companies like Palantir, who are in the upward swing of things on a sentiment level. So all these analysts right now, I spoke about this with Sam. Fundamentally, I think Palantir should retrace back down, but I can't run the risk of these analysts coming out and saying, screw this, we're going to give it a higher price target just so that they don't feel like they got caught off sides, And a lot of them don't have the balls to basically be contrarian. So they always tend to just lean towards the way that the market is moving. And so sometimes it's kind of sad because this is why I don't trust analysts anymore. I try to like judge my own. I use them to get a fundamental like reading of what the sentiment is, but I barely ever say, oh, you know, just because this one analyst said that the stock is going to go to here, that's actually going to happen. And believe it or not, the amount of times that they've been right for a lot of analysts is less than 50%.
Right.
So why would
Right.
you even want to believe in any of these guys? So do your own due diligence, believe it or not. And you've been doing this for the last 3 years. You can tell that this is not as hard as a lot of these people make it out to be. Like, bro, you have a better track record than most of these analysts who completely missed Robinhood. Completely. Shit was trading under book value. They had more cash on the balance sheet. But did one of these analysts come out and say, hey, I think Robinhood is a buy because it's trading at below cash? You know?
Yeah.
No. So like I said, trust your own judgment. Use the analysts for what they are. You know, just
Do you think we drop after earnings on Palantir, or if you had your gut feeling on it right now?
My gut feeling is they better have some really, really good numbers. Otherwise, they could be sold off here and there. But to be honest with you, my insides are telling me like, no, they're gonna have a great quarter. Like all the AIP stuff. This is okay. I'm gonna reveal something on this live stream that
It's not inside information, right? Nothing
It's
crazy.
not inside
Okay,
information.
good.
There are times where I really, really regret selling Palantir. And the reason why I regret selling Palantir is not because of valuation and all this other stuff. It's because a lot of the changes that we spoke about on Palantir Weekly, that they should be doing this and they should be doing that. And we had Coach Strap telling us like, yeah, they need to do this. They started applying those things. And me being a dumbass, I didn't change my tune. And I said, you know what? Wait a second. We said, yeah, they need to do more outreach to developers. They need to do more outreach. They need to do more, like the AIP cons of the world. We actually said that, if you remember, 2 years ago.
I remember.
And
I was down a lot of money, so I remember.
And now they started to do that, and they're seeing the tangible benefits of it. But I did not follow in my brain.
So why don't you, in front of 1,150 people, just say you're going to buy 1,000 shares at $27, bite the bullet? We'll welcome you back in. I told you this a couple weeks ago.
No, I missed the boat. My thing
You didn't miss the boat, Chris. You didn't miss the boat.
I'm not gonna chase it. No, I'm not gonna chase it. I'm not gonna chase it. The thing is, bro, I don't have the conviction to see this thing at $30. So the upside is very limited, whereas other parts of the market right now, I just have so much more conviction. So
It's 1,000 shares. 1,000 shares is a couple pennies for you. 1,000 shares is a starter position. That's all. That's all we're asking.
No, man. If anything, I'll probably sell some puts just to say like, oh, maybe like this is the entry price that I want to be in. And I'm not normally a guy who likes to wheel stocks, but dude, Palantir is worth wheeling. You know, especially the puts, because the premiums are pretty juicy if you get it at the right time. So.
It sounds like you're getting bullish, Chris. Now you're making me afraid that this thing might tank after you're getting super bullish now.
You want to know what gives me the biggest like bearish like narrative? Every time that guy Jamin Ball from Altimeter posts that stupid chart with the EV to next 12 months trailing, and I see Palantir at the top, and I see the valuation absolutely fucking high, it just brings like something inside me just makes me nervous, right? But I have to like remind myself, if it's a quality company, fuck the valuation, just buy it, you know? But I just, right now, I don't have the conviction. So right now, I'm not in it with you guys. If it retraces below the 20s, I'm more than likely going to be, selling some puts and seeing if I can get in again at a lower price. But
So your price target to get in basically is like 18-ish, is what you're saying.
Yeah, 18. Like I'm hoping that I can get into it at 18. So if it drops to like 20, I'll probably start selling puts on it. And basically, if I get assigned, I get assigned. Otherwise, I'll just collect the income, and in which case I'll be fine. I think, like I said, for me right now, I think there's a lot of other plays out there that I'm more heavily like concentrated on, primarily because I've done so much research into them that I have a lot more of a bullish take, which means that I'm not borrowing someone else's conviction. I can actually hold that position even into some weakness. Whereas Palantir, I might end up weekending and selling out because I'm being a biatch, right? So these are the kinds of things, like one of the things that every investor has to do is have some self-realization on their investing, what's the word?
style.
Temperament.
I guess.
Temperament. Like, I know my temperament. You should know your temperament. If you're like one of those people that, hey, I can buy and hold even if it goes down 90%, that's the way you should invest. Me, I know that I can't tolerate a 30% drop and not feel like a shitbag. So I try not to be in companies where I think a 30% drop could happen, you know?
All right, Chris, one more question. And again, guys, I'm leaving in like 2 minutes. The YouTube meta stream is already set up. We're going to end the stream and go to the meta stream at 3:45 and start the market close. Chris, real quick on meta, what do you think we get after hours?
Bro, Meta is just a cash flow machine. That is an ATM on crack. And I don't know what's going on with Zuck, but Zuck has just entered his like cool guy phase. I'm all for it, bro. I'm all for Meta. Meta is gonna do well. They just print so much cash. So I think it's fine. I think it's fine. They're gonna do well.
Okay, sounds good. Thank you for calling in, Chris. We will see you on the next one.
Yeah, call me later about the hood thing.
Yeah. I'll talk to you after the market close. I'll call you.
Take care.
All right, bye. Okay, cool. So markets are retracing a little bit right now. So we went down from 228 on IWM back to 224. That's okay. Overall, I think it gave you a preview of what would happen when the rate cut happens. We've seen this retracement almost every time after J Powell speaks. Pound share 2705, SoFi 753, and phase 115. So we had a really bullish market. Market sold off a bit. Now and the reason it sold off, quite frankly, is because this guy, Meta's about to report, Qualcomm's about to report, ARM's about to report. We've got a lot of earnings in 15 minutes. Carvana is going to report, Etsy is going to report, Enovix is going to report, Teladoc. So all these companies, Meta being the biggest, is going to determine a lot about what happens the rest of the day and the rest of the week. Okay, cool. I'm leaving this stream. I'm going to the next one. Let me put the link in the chat for those that don't have it. We're going to the Zucks live stream. We'll talk about all the earnings, and hopefully it's a little less emotional than it was yesterday when Microsoft crashed, but we will see what happens. All right. I'll be there starting at 3:45. Bye, everyone. See you there.